It feels like throwing the most successful sold-out event of the entire year.
Oh, absolutely.
Like the venue is packed, the merchandise is flying off the shelves, everyone is just having an amazing time, and you are breaking every single revenue record you have ever set.
Right. The dream scenario.
Exactly. But then the next morning, you wake up, you check your bank account, and you find out you are overdrawn by nearly $250 million.
Which is just a terrifying feeling.
It really is. You are looking at the cash register, and it is saying one thing, and the accountant is saying something completely different.
Yeah, it is the ultimate financial whiplash. I mean, the operational metrics and the accounting ledger seem to be living in two entirely separate realities.
And that paradox is exactly why we are here today. So welcome to today's custom-tailored deep dive. For you, the listener, trying to evaluate corporate financial health without getting lost in the spin, we are going to explore the mechanics behind one of the most fascinating earnings reports we have seen this year.
It really is a standout report.
We are looking at the Q4 and fiscal year 2026 earnings presentation and the press release from Columbus McKinnon, or CMCO, which dropped on June 4, 2026.
Yeah, and Columbus McKinnon is just a brilliant test case for understanding modern corporate transformation.
For sure.
We are talking about a 150-year-old industrial business. I mean, historically, they made heavy-duty hoists, cranes, rigging hardware. The literal iron and steel equipment that physically built the modern world.
Right, the heavy lifting stuff. But our mission today is to look past those headline numbers to see what happens when a legacy company tries to essentially forcefully drag itself into the future.
And it is a forceful drag.
Because those headline numbers are staggering. Like, how does a company report record-breaking sales of $1.2 billion for the fiscal year, yet simultaneously post a massive net loss of nearly $250 million?
It sounds impossible when you say it out loud.
It does. So to figure that out, we are going to look at the mechanics of corporate acquisitions, the stark differences between GAAP and non-GAAP accounting, and, what it actually costs to fundamentally rebuild a 150-year-old business model.
Right.
Okay, let's unpack this.
Yeah, let us start with the sheer scale of the top-line illusion. Because if you read the executive summary of their press release, they paint a picture of a company operating at the absolute peak of its powers.
I mean, for fiscal year 2026, their net sales hit a record $1.2 billion. That is up 24% year over year.
Which is huge for a legacy industrial company.
And it doesn't stop there. Their orders also hit a record $1.2 billion, up 20%. And if you are wondering if this is just some temporary spike, their backlog is sitting at a massive $520 million.
Yeah, that backlog is up 61%.
Which is wild. So that is $500 million in orders they have secured but haven't even shipped yet.
What's fascinating here is that the core engine is undeniably humming. I mean, even if we completely strip away all the complicated mergers and acquisitions they executed this year, the underlying legacy CMCO business still grew its net sales by 7%.
Organically.
Yes, organically. They successfully raised prices to offset inflation, they pushed more volume out the door, and they saw double-digit growth in their short-cycle businesses.
Was linear motion and automation.
Exactly. The automation side is really taking off.
I have to pause you there, though. Because if they are pushing record volume, raising prices, and sitting on a $500 million backlog, how do we reconcile that operational success with the net loss?
Right, the 54% net loss margin in the fourth quarter alone.
Yeah, I mean, you don't lose $238 million in a single quarter because you had a slightly bad month of selling conveyor belts.
You certainly do not. The core business of selling industrial motion solutions is actually highly functional. That $230 million GAAP net loss for the year, that $7.40 loss per share, isn't because the factory floor is ground to a halt. It is because of a series of specific, massive, singular events that hit their financial ledger.
So it is a paperwork issue.
Essentially, yes. We have to separate the operational health from the accounting mechanics.
Let's dissect the anatomy of that $230 million loss then. Because when you dig into the sources, the biggest hit by far wasn't even cash leaving the building.
No, not at all.
It was a $200 million non-cash goodwill impairment charge. And this is where, accounting rules can deeply distort reality for the casual observer.
Definitely. So the rules of GAAP, generally accepted accounting principles, they require companies to constantly test the value of their past acquisitions.
Okay, so checking the receipt.
Basically, when Columbus McKinnon bought previous companies, they paid a premium over the raw value of the physical factories and the inventory.
Right.
That premium, which accounts for brand value, customer relationships, expected future cash flows, That is recorded on the balance sheet as an intangible asset called goodwill.
And the impairment was specifically tied to their precision conveyance reporting unit, right?
Exactly.
The earnings report notes that this write-down was triggered because Columbus McKinnon suffered a sustained decline in their stock price.
Yeah, Wall Street punished their market capitalization.
To the point where the combined equity value of the company actually exceeded its market cap. So the accountants essentially forced management to recognize that gap on paper.
It is a painful adjustment to make in a press release for sure.
Yeah.
But it is crucial for an analyst or for you listening to recognize that this is a paper loss.
So is this essentially like buying a vintage car, like a classic Mustang, and then realizing the broader market value of that specific model just dropped?
That is a great way to put it.
And so you are forced to write down your personal net worth on paper, even though the car still runs perfectly and, gets you to work every single day.
That analogy perfectly isolates the accounting mechanic.
Yeah.
Yes. The earning power of the asset remains functional, but the premium you paid on paper is just gone.
Okay, that makes sense.
However, we cannot just wave away a $200 million write-down as mere paperwork. We do have to apply some critical thinking here.
What do you mean?
Well, while it is non-cash, it does reflect a very real, measurable pessimism from the broader market about the stock price.
Yeah.
Investors don't just compress a valuation for no reason.
That is fair. And the report explicitly outlines the real-world headwinds feeding that pessimism. They note the dilutive impact of tariffs, which directly raises their cost of goods.
Right.
And they mention an unfavorable product mix in the quarter. But the macro stuff is what really caught my eye. They cite softness in the EMEA region, Europe, the Middle East, and Africa, and they specifically call out the conflict in the Middle East.
We have to look at how those geopolitical realities mechanically affect global industrial demand. It is all connected.
How so?
Well, when conflict disrupts shipping lanes in the Middle East, freight costs spike, and supply chains get incredibly nervous. Companies delay their large capital expenditures.
I see.
If a European manufacturer decides to, say, delay building a new automated warehouse by 12 months because of regional uncertainty, Columbus McKinnon, the company that makes the automated conveyor belts and hoists for that warehouse, they feel the direct ripple effect in their order timing.
Right, that makes total sense. It is a delay in global capital expenditure. But that $200 million paper loss still leaves us with other massive line items dragging down the bottom line.
It does.
Because the sources show $93 million in deal-related costs over the year, with $68 million of that hitting just in Q4 alone.
Yeah, the deals were expensive.
Plus another $37 million in something called acquisition inventory step-up amortization expense. Explain the inventory step-up, because that just sounds like another accounting trick.
It is. Inventory step-up is a mandatory accounting quirk, and it punishes the income statement immediately after an acquisition.
How does it punish them?
Well, when you buy a company, you acquire their existing inventory.
Yeah.
GAAP requires you to mark up the value of that inventory from what it cost the acquired company to make it up to its current fair market value.
Oh, wow.
So when you actually sell that inventory to a customer later, your profit margin looks artificially tiny or even negative because your recorded cost was stepped up to the sales price.
So they are penalized for selling the inventory they just bought.
In the short term, yes.
Yeah.
It makes the bottom line look drastically worse than the actual cash economics of the transaction. The cash profit is there, but the accounting profit is just erased by the step-up.
Which perfectly explains why Columbus McKinnon practically begs investors to look at adjusted EBITDA rather than GAAP net income.
Exactly.
Because when you strip out that $200 million paper impairment, the $93 million in deal costs, the $37 million in inventory step-ups, and, a few other restructuring charges, their adjusted EBITDA is actually a positive $181.4 million.
With a 15.2% margin.
Wow. Right.
Adjusted EBITDA removes the noise of capital structure, taxes, and those accounting anomalies to show the operating profitability of the core business.
And a 15.2% margin is pretty healthy.
It indicates a highly viable industrial enterprise. But we shouldn't ignore the noise entirely, because that noise was generated by the most aggressive strategic pivot in the company's history.
Here's where it gets really interesting. If deal costs and inventory step-ups are responsible for so much financial disruption, what exactly did they buy that caused all this?
Right. What triggered all these accounting mechanisms?
Yeah.
The catalyst for this entire fiscal year was the Kito Crosby acquisition, which officially closed on February 3, 2026.
This was a massive deal.
Transformative. In just the final weeks of the fiscal year, Kito Crosby added $188 million in revenue, and it added $200 million to the backlog.
It is a profound leap in scale. But the whiplash isn't just about what they bought, it is about what they sold.
Yeah, the timing is wild.
Almost exactly 1 month later, on March 4, 2026, Columbus McKinnon executed a divestiture. They sold off their U.S. power chain hoist and chain manufacturing operations, excluding the Little Mule products, and netted a $103.3 million gain on the sale. I find this completely counterintuitive. Why go through the operational headache of selling off a chunk of your own legacy business right in the middle of closing a massive, complex acquisition?
It seems chaotic.
It sounds like trying to remodel your kitchen and sell your garage on the exact same weekend.
If we connect this to the bigger picture, it is actually a masterclass in strategic repositioning.
Really?
Yes.
Wow.
Columbus McKinnon is not simply trying to get bigger. They are trying to fundamentally change the margin profile of the entire company.
Okay, how so?
The visual context provided in their earnings presentation makes this incredibly clear. On one side, you have imagery of their legacy rigging, hardware-heavy galvanized shackles, manual hoists, the basic Crosby iron of material handling.
Essential, sure, but totally commoditized at this point.
Exactly. It is a mature, slower growth, lower margin market. But on the other side of the presentation, you have visuals of Kito robotic arms seamlessly working alongside high-tech automation systems. Columbus McKinnon calls this strategy intelligent motion. They are shedding the legacy, lower-margin parts to focus purely on higher-margin automated systems.
So it is an exercise in pruning the tree to let the new branches grow.
Precisely.
But wait, how does intelligent motion actually change the underlying economics? Are we just talking about slapping, like, a Bluetooth sensor on a crane, or does it fundamentally alter how they make money?
It transitions them from selling a piece of hardware to selling an integrated system.
Oh,
A standard chain hoist just lifts a heavy object. An intelligent motion system lifts it, analyzes the load weight in real time, communicates that data to a cloud server, predicts its own maintenance schedule, and places the object onto an automated conveyor belt.
wow, with millimeter precision.
Right. When you sell software, connectivity, and precision automation alongside the iron, your profit margins expand dramatically, and your customers become far more locked into your ecosystem.
I see. So selling the legacy chain hoist business provided a $103 million cash injection right when they needed liquidity for the Kito Crosby deal.
It was perfectly timed.
But, pruning the tree and buying robotics companies requires actual liquidity. We've established that the accounting loss is mostly paper and strategic pruning, but buying companies requires a real bank account.
You definitely cannot pay your vendors with adjusted EBITDA. You need cash.
Right. So for the listener trying to evaluate the real risk here, how does their actual bank account look right now?
Well, this is the ultimate reality check. On a strict GAAP basis, their net cash used for operating activities was negative $146 million, and the free cash flow was negative $164 million.
Okay, a negative $164 million free cash flow is an immediate red flag for any analyst.
It is, until you dissect the cash outflows.
What do you mean?
The company provides a reconciliation metric called free cash flow excluding deal costs.
Okay.
If you strip out the staggering $205 million they had to pay in cash for Kito Crosby integration costs and transaction fees, and you remove the $27 million in cash taxes they owed on the divestiture.
The taxes on selling the hoist business.
Exactly. When you remove those, the underlying company actually generated a positive $68 million in free cash flow.
Okay, so the core engine is throwing off $68 million in actual usable cash, but they are dragging a massive anchor to make this pivot happen.
They are.
Their credit agreement net leverage ratio currently sits at 5.1x.
Yes, 5.1 times.
So what does this all mean? If you are evaluating their financial health, is a 5.1x leverage ratio a giant red flag? Or is it just the reality of being heavily mortgaged on a brand new, high-value property?
This raises an important question about capital allocation and risk tolerance.
Right.
A 5.1x leverage ratio is aggressively high for an industrial manufacturing company. It leaves very little margin for error. However, you have to look at their total liquidity profile to judge the immediate danger. They currently have $561 million in total liquidity.
How does that break down?
It comprises $459 million available on a revolving credit facility and nearly $97 million in cash on hand.
I am going to push back on that optimism just a bit. Having a massive line of credit isn't exactly the same as having financial security. It just means the bank hasn't cut you off yet.
That is a very fair point.
The management team explicitly stated in the report that their commitment is to use future cash to aggressively pay down debt and deleverage in the near term. They know this ratio is dangerous.
They absolutely do.
The positive $68 million underlying cash flow proves the engine is running, sure, but now they just have to use the exhaust to pay off the mortgage before the interest eats them alive.
Your assessment is spot on.
Yeah.
The liquidity gives them a runway, but the debt service is a ticking clock.
Yeah.
They have bet the balance sheet on their ability to execute.
Yeah.
And that sets the stage perfectly for their fiscal year 27 guidance.
The promised land, right?
Exactly. They took the financial pain, the accounting write-downs, and the massive debt load in FY26 to position themselves for a massive leap in scale.
And the leap they are projecting is stunning. For you listening, if you are prepping for a meeting or trying to understand how to read corporate health, this is your aha moment.
Absolutely.
Because the headlines scream a $230 million loss, but the guidance shows a company that just doubled its revenue run rate to over $2 billion overnight.
It's a totally different company now.
They are projecting FY27 net sales of $2.05 billion to $2.12 billion. Adjusted EBITDA is expected to reach between $390 million and $410 million.
Massive jumps.
And adjusted EPS is projected at $1.72 and $1.90. But to your point about the ticking clock, how realistic is it to suddenly manage a $2 billion machine when they are carrying such heavy underlying costs?
The structural costs of this transformation are daunting. The FY27 guidance assumes $185 million to $190 million just in interest expense.
Wow.
Nearly half of their projected adjusted EBITDA will go straight to the bank just to service the debt. Furthermore, they are projecting $135 million to $140 million in amortization expense.
There is also a highly specific detail in the report about how they funded this acquisition that shows just how tight the cash situation really is.
The preferred shares.
Yes. To help pay for the deal, they issued 800,000 preferred shares. But instead of paying the dividends on those preferred shares in cash, they will be accrued and compounded during fiscal 2027.
Right, a payment-in-kind mechanism.
They're literally rolling dividend debt forward to preserve cash today. It is a highly leveraged tightrope walk.
It creates an incredibly precarious situation if growth stalls. But the key metric that determines whether this gamble pays off is the $70.6 million in estimated annual net run rate cost synergies they have promised from the Kito Crosby integration.
Synergies always sound great on an earnings call, but what does $70 million in synergies actually look like in terms of operational execution?
Well, mechanically, it means identifying redundant middle management and eliminating those positions.
Okay.
It means aggressively consolidating manufacturing footprints, closing a legacy factory, and moving that production line into a more efficient, newly acquired facility.
That sounds complicated.
It is. It means merging two massive, distinct ERP software systems without accidentally stopping production or losing customer orders, and using their combined purchasing volume to force suppliers into better pricing tiers.
But spreadsheets don't run factories. The math works beautifully on paper, sure, but the true test is operational execution. They have to blend two massive organizations, navigate those high-interest expenses, and deliver the promised intelligent motion strategy without missing a beat.
All while navigating a tough macro environment.
Exactly. It is a high-stakes gamble on the future of industrial automation.
And this brings us to a broader concept that I think is vital for you, the listener, to mull over long after this deep dive ends.
What's that?
Columbus McKinnon is betting its entire financial structure on the future of intelligent motion. Consider what that means on a macro level. If a 150-year-old industrial manufacturer, a company whose identity was forged in heavy steel shackles and manual hoists, is willing to take on massive debt, acquire robotics companies, and post a $250 million paper loss just to reposition itself for the automated future.
Yeah.
What does that signal about the urgent physical transformation happening across global supply chains right now?
Wow. It signals that the future of logistics isn't just approaching, it is already here, and it is incredibly expensive to adapt to.
Exactly. They're absorbing immense financial pain today to ensure they are the ones building the infrastructure of tomorrow.
So we've gone from the paradox of throwing a sold-out event that leaves you broke on paper to realizing that you didn't just throw a party. You took out a massive loan, bought the entire venue, upgraded the sound system, and booked out the calendar for the next 5 years.
A perfect summary.
The cash register might look empty today, but the underlying machine has been fundamentally upgraded. Thank you for joining us on this exploration of the numbers behind the narrative. Keep questioning the headlines, keep looking past the gap net income, and we will catch you on the next deep dive.